returns of about 9% across US equities, returns about 9% for European equities. Asian equities, though, the MSCI Asia Pacific Index, that year to date is up about 4%. Do you rethink that call about being underweight DM on a tactical basis?
Well, if you look at actually, you talked about US equities returning really handsomely so far this year, but if you take out the top 7 big tech names...
It's very narrow.
It's very narrow, then it's flat, right? Equal weighted US equity market is basically flat on the year. So it really goes to show there are cracks appearing underneath the surface in the same way that there are cracks appearing underneath the somewhat resilient economic picture. So even more important to number one, be very selective, focus on quality as we think about growth slowing down, but also staying invested given the huge amount of uncertainty and volatility out there. If you miss out one of those daily moves and rebounds, then actually you could really miss out on the accrual returns.
So, wait, how many, I mean, if you look at the industries, there are some that will be okay in defending their margins and some where it will be actually impossible. Is that shifting as we also see the cost of living going up?
While companies can only get away with passing through cost of production to end consumers for as long as consumers are happy to pay for that price and for as long as they have that purchasing power. Our expectation is that the savings buffer for consumers, US consumers included, are likely going to be exhausted towards the second half of this year. And when that happens, it's going to be even greater differentiation within the sectors themselves, because only the leading sectors, the leading companies, the companies with pricing power are able to do that. So we're talking about being very differentiated on the sector front, but also within sector itself. So the time for selectivity is really now.